Imagine the Federal Reserve announces a rate cut. The headline says money is getting cheaper. Then the 10-year Treasury yield climbs instead, pulling long-term borrowing costs the wrong way. If the Fed sets interest rates, who just overruled the Fed?
That would look like the bond market was fighting the central bank.
Or it would reveal that interest rates are not one switch. The Fed directly controls one corner of the system. Investors price the rest.
And right now, that distinction matters. A large wave of government borrowing is approaching while inflation, growth, and future Fed policy are still being debated. One rate can fall while another refuses to follow. So which rate does the Fed actually control, what moves the 10-year yield, and what would prove that the bond market is truly resisting a rate cut? That is today's experiment. Start at the short end. The Federal Reserve sets a target range for the overnight federal funds rate. That rate influences very short-term funding and anchors expectations for Treasury bills and other short maturities.
If traders expect several cuts, 2-year yields can move before the Fed acts. The front of the curve is constantly repricing the likely path of policy.
But expectation is not control. A forecast for cuts can disappear when inflation remains persistent or the economy proves stronger than expected.
Now move farther out. A 10-year Treasury yield has to compensate an investor for holding government debt across an entire decade. That calculation includes expected short-term rates, expected inflation, future growth, and extra compensation for uncertainty.
In other words, the Fed has a powerful vote. It does not own every vote.
The bond itself adds another piece. When demand for a Treasury bond rises, its price rises and its yield falls. When buyers demand a larger return, the bond price falls and the yield rises.
That is where supply enters. The Treasury expects to borrow $671 billion in privately held net marketable debt during the July to September quarter. More debt has to find buyers.
More supply does not guarantee higher yields. Demand may rise at the same time, especially if investors fear a slowdown. But if supply grows while buyers demand more compensation for inflation or fiscal uncertainty, long yields can remain firm even as the Fed eases.
The Congressional Budget Office projects a federal deficit of roughly $1.9 trillion for fiscal year 2026, with debt held by the public near 101% of gross domestic product. That turns Treasury issuance from background noise into part of the rate mechanism. Here is the central conflict. A Fed cut can say, short-term policy is becoming less restrictive. A stubborn 10-year yield can answer, long-term inflation, supply, or uncertainty still deserves a premium.
The momentum case is visible when several markets agree. The 2-year yield falls with cut expectations, but the 10-year yield holds up. The yield curve steepens, and rate-sensitive assets stop receiving the relief the policy headlines seem to promise.
But do not assign one cause from one chart. A rising 10-year yield can reflect stronger growth expectations, inflation concern, weak auction demand, heavier supply, or some combination. The shape of the move matters more than the headline.
That is why the Fed cut, so bonds must rally is not analysis. It skips the mechanism. The same split reaches other markets. A higher long-term yield raises the discount rate applied to distant corporate earnings.
That can matter most for growth stocks, where a larger share of the valuation depends on profits expected far into the future. If long yields fall, that pressure can ease. If they stay high, a Fed cut may deliver less valuation relief than investors expected.
The dollar is more complicated. Relative yields matter, not just the direction of one U.S. rate. And gold can respond to real yields, inflation expectations, currency moves, and demand for safety. There is no single automatic trade attached to a rate cut.
Think of the 10-year yield as a market scoreboard for several arguments happening at once, not as a remote-controlled extension of the Fed. So what would confirm that long yields are genuinely resisting easier policy?
First, the front end would need to price easier Fed policy while the 10-year yield remains elevated or rises. Second, Treasury auctions would need to show that buyers require more yield to absorb supply. Third, inflation expectations would need to resist the disinflation story.
And here is the invalidation. If growth data weakens, inflation expectations cool, and auction demand remains strong, long yields can fall even with heavy issuance. Supply is pressure, not destiny.
The next checkpoints are the Federal Open Market Committee minutes on July 8, followed by the June Consumer Price Report on July 14. The minutes can clarify the policy debate. Inflation data can test whether the long end still needs that extra compensation.
Watch the reaction across the curve, not merely the first move after a headline. A one-day jump is not a regime.
There is a popular internet trick that turns this into a secret signal. The Fed will cut, therefore this asset must rise. That is not a hidden edge. It is a missing equation.
The complete equation asks what the market expects before the decision, what long-term risks are being priced, and whether buyers are absorbing new bond supply comfortably.
It also asks what would prove the story wrong. Without an invalidation condition, a macro explanation can be stretched to fit any outcome.
The useful framework has 3 layers. Policy controls the short end. Expectations connect short rates to longer maturities. Inflation, growth, supply, and uncertainty determine whether the long end follows. So, who can overrule the Fed? No single person. It is the combined price demanded by millions of bond market participants for lending across 10 years.
The Fed can cut overnight rates while the long end says the economy, inflation, or debt supply still requires a higher return.
Or the long end can fall if weaker growth and stronger demand overwhelm those pressures. The point is not to predict which side wins. It is to identify the evidence that would confirm either mechanism.
The next time you hear the Fed cut rates, ask a better question. Which rate moved, which rate did not, and what is the yield curve telling us about the difference? That is the experiment. Subscribe for the next Weekend Lab, and follow the Daily Market Notes at Market Validation Lab on X.